Hello, it's a pretty lovely good evening once again from here, and hope that each one of you are absolutely fine, happy, and of course in fine spirits. So now we are moving and stretching our discussion a bit further. So far we have had discussed in the earlier sessions regarding the what we call initial conceptualities of this particular chapter. And after having a bit of discussion, now we shall move over to, as I told you, a little bit higher section, that is comprehensive questions. Section 2 now we are picking up. So kindly open down your notes, and through this particular question 2.1, we would try to actually recap whatever we have done in our earlier phases of education with respect to this particular chapter, admission of partner, correct? So primarily, we are doing this particular question just to recap the things which we are already acquainted of with. Just we are trying to actually recap the things, correct? So here we go, and hope that you have opened your notes and kindly have a look over the question. Balance sheet of Parker and Knight is given to you. Correct? Two partners are there. Comprehensive question. You are already aware of this particular fact that under the admission of partnership, comprehensively when we solve the question, it means we are supposed to prepare the revaluation account, capital account, of course cash account, and besides that we are supposed to prepare the balance sheet, correct? So balance sheet of Parker, Knight, and they are sharing profits and losses in the ratio of 3:2. The balance sheet is given as on 31st of 2022. And this balance sheet is as follows. It's a very small balance sheet because we have to just recap the things. The capitals of the partners, correct, is given to you, Parker and Knight, 3 lakh and 2 lakh. Besides that, we have got creditors. And fixed assets are worth rupees 5 lakh and cash in hand is 5 lakh. Total is 6 lakh. This is the small balance sheet which is given to us in this particular question. Correct. Now we shall move a bit further now. Here, what is given to us? Let's have a look. On this date, Roger is admitted into the firm. A new partner, or Roger, is admitted into the firm for a fifth share. This is the point which you must take into account. Who is the new partner? What is his profit sharing ratio? And how much he is bringing in? He is supposed to bring in 1 lakh as capital and 50,000 as goodwill. He is supposed to bring 1 lakh as capital and 50,000 as goodwill. That means his share of goodwill is 50,000, which he is supposed to bring in. Further, as you know, in your earlier phases of education, you are well aware of this particular fact that at the time of admission, we do the revaluation of the assets and liabilities. So here it is written, also an independent revaluation was done, which reflected that fixed assets are overvalued by 1 lakh. So fixed asset, which we have written in the balance sheet, it is given in the question that fixed assets are overvalued by 1 lakh. What does it mean? It means the market value of fixed asset is just 4 lakh. But we have written the fixed asset in the balance sheet at rupees 5 lakh. So that is why question is stating that fixed assets are overvalued by 1 lakh. So overvalued by 1 lakh means we will have to bring down the value. That doesn't mean it is a gain. Most of us actually sometimes get confused when the line is given in this manner. So it is very important for you to keep track of this particular point. It means fixed asset in the balance sheet have been reflected at a value which is higher than the market value. Your market value must be equal to 4 lakh. And that is why it is written that these fixed assets are overvalued by 1 lakh. So you have to bring down the fixed asset by rupees 1 lakh. It is a loss to you, as you know that all the losses will be put to the debit side of the revaluation account. Further, it is written that creditors were estimated. Further, it is given in the question that creditors were estimated at rupees 50,000. Creditors were estimated at rupees 50,000. Now, you have written in your balance sheet that you are supposed to pay to the creditors 1 lakh rupees. But below it is given, now it is estimated that you are not supposed to pay 1 lakh. Rather, you are supposed to pay only 50,000. So, should I construe it as a gain or as a loss? If my liability would decrease, should I consider it as a loss or a gain? So it should be a gain. Yes, absolutely, because you have recorded liability at rupees 1 lakh. You are under an impression that you are supposed to pay to the creditors 1 lakh. While checking the things, now you found that actually you are supposed to pay only 50,000. So quite obviously it is a gain to you, and you are going to take 50,000 to the credit side of the revaluation account. Further, it is given besides an unrecorded bill showing expenses paid in advance worth rupees 10,000 was found. Now, if I am going to ask you what will be the treatment of this unrecorded bill, many among you will be tempted to think that it is a loss, because most of you are familiar with only one fact, that if there is something unrecorded, it should be considered as a loss. No. It is an unrecorded bill with respect to prepaid expenses. Please go through the line once again. Besides an unrecorded bill showing expenses paid in advance, you have already paid the expenses in advance, but you have forgotten to record it. So it is a sort of asset for you. So it is a gain to you. This unrecorded bill is in connection with prepaid expenses. You have already paid the expenses, but you haven't written it in your balance sheet. So suddenly, while at the time of admission, you check the things and you found that you have a bill regarding the expenses prepaid, but you haven't recorded it. So now you are going to record it. It will be considered as a sort of gain for you. Is it clear to you? So it is a gain to you. Now, this is the common question, correct? Till up to this particular stage, this is the common question, and I have attached 5 cases. Actually, you can say this question combines 5 questions. Correct? Because we have to recap the things, whatever which we have done in the past. Is it clear to you or not? Here it is written, first of all, case A says that show the necessary ledger accounts and write entries with respect to goodwill. So your first question with respect to this particular case study is that you are supposed to pass the entries with respect to goodwill, and of course you are supposed to prepare the ledger accounts. Is it clear to you? So I hope you have the question in front of you, because I need a little bit of space, so I will have to create the space. And what I will do then, I will create the space just to make you understand in a better manner right now. So space has been created. So we will take up this particular question, and if you want to write, you can, otherwise it's fine. Even if you are not going to write, don't worry about that. I'm not going to force as far as this particular thing is concerned. So question of section 2 and question number 2.1 we are picking up. And as I said, the first case we are going to pick up. Correct? It's a comprehensive question. You are already well aware of this, and you can easily manage this question of your own too. I'm very sure about this. But still, actually, we will do. I do not want to actually leave anything to chance, and I just want to start right from the scratches. Correct? So we are recapping the things which we have already done and regarding which we are already familiar with, and we are already well acquainted with all the concepts. But still, we are actually going to recap that. So first of all, at the time of admission of a partner, 2 things you need to know very carefully. What is the old ratio? Old ratio in the question, it is given as 3:2. Second, what is the profit sharing ratio of the incoming partner, and who is the incoming partner? Roger is the incoming partner. He is coming up with what we call 1/5 share. Third thing which you need to note down, what is his share of capital, how much he is supposed to bring in into the business, and what is the share of goodwill. Is it clear to you? So far in this particular question, I have kept the sheets of the question in front of me towards my left side. You can see these are the sheets also. So I would like you to, because time and again I cannot flip through this. So it is clearly written in the question that new partner will be admitted for 1/5 share and is supposed to bring in 1 lakh as capital and 50,000 as goodwill. So he is supposed to bring what we call capital, besides that what we call 50,000 worth of goodwill. So first thing what we are going to do, because question has also asked us to pass the entries. So entries in connection with capital and goodwill, first of all I am going to write here. And for that, my first entry will be cash account debit. Cash account debit. Obviously, it's a very common, innocuous entry, and each one of you are very well aware of all these things. I need not require to tell you time and again. Correct? So this will be my first entry. First entry will be cash account debit to Roger's capital account. Who is the new partner? New partner is actually Roger. So I'm simply putting up R. Correct? And he's coming up with rupees 1 lakh worth of capital. So I'm going to write cash account debit to R's capital account. This is the entry you need to write with respect to capital brought in. Correct? Now, second point is, he's supposed to bring 50,000 as a share of goodwill. So we shall write here cash account debit. Once again, cash account debit. 50,000, isn't it? To premium. It's a pretty long word, but still I'm going to write premium for goodwill account. And from next time, I will write in short form PFGW, premium for goodwill. It is better to write whenever new partner is going to pay you his share of goodwill in cash. It is always better to write this entry first, cash account debit to premium for goodwill. Is it clear to you or not? 50,000. 50,000 we are going to write here. We have already seen in our earlier discussions that why a new partner is asked to bring his share of goodwill, correct? Because when a new partner gets admitted into a new firm, quite obviously old partner will sacrifice something, because earlier they were sharing the ratio in entire profits of the concern in the ratio of 3:2, but now there will be three partners, so quite obviously their share will decrease a wee bit. That means because of admission of a new partner, old partner loses out a wee bit. And new partner is asked to compensate the same. So that is why new partner is asked to bring what we call something extra besides from his capital to compensate the old partner for the fact that they have lost out their share of profit a wee bit. So that is why we can say that goodwill, the share of goodwill which is brought in by incoming partner, is nothing but it is a sort of compensation which is paid by the incoming partner to the old partner. Why? Because of his admission, old partners have lost out what we call some portion of their share of profits. That is why whatever goodwill which is brought in by the incoming partner must be credited to the old partners. Of course, as we have seen, goodwill will be credited to the old partners in their sacrificing ratio. So in this particular case, your next entry will be, the moment you are going to pass this entry must follow. Is it clear to you or not? We are starting right from the what we call scratches. So your next entry will be premium for goodwill account. Whatever goodwill which has been brought in by the incoming partner, that is 50,000. Now you are going to credit this amount of goodwill to the old partners. Old partners in this case are Parker and Knight, to Parker's capital account to Knight's capital account. Now, obviously, you will have to credit the same in sacrificing ratio. However, I have already told you so many times now, and you are already well aware of this also, that sacrificing ratio is nothing but, as you know, is it clear to you? You can compute sacrificing ratio with the help of the formula very easily. You can simply subtract from the old ratio, new ratio, you can find out the sacrificing ratio. But we have already seen in our earlier discussion that generally we do not require any computation of sacrificing ratio if we are very well aware with all the fundamentals. I've already told you, if in the question only old partners profit sharing ratio is given and new partners profit sharing ratio is given, then it means the sacrificing ratio is nothing but your old ratio. So I need not require to compute the sacrificing ratio. I can simply state it as 3:2. The sacrificing ratio will be 3:2. So 30,000 will be credited to Parker and obviously 20,000 will be credited to Knight. Clear? So after having taken care of the capital and the goodwill, your next step should be preparation of revaluation account. Now we are going to prepare the ledger accounts. So in order to prepare the ledger accounts, correct, this should be our second step, ledger accounts. Now we shall prepare the ledger accounts. Ledger accounts, okay. So ledger accounts we shall prepare. In order to prepare the ledger accounts, obviously, first of all, I am going to prepare the revaluation account. And you are very well familiar with how to prepare the revaluation account, isn't it or not? Revaluation account. In partnership, revaluation account is almost like a profit and loss account, to be very honest with you. But here we use the word revalue because all the losses and gains which arises because of revaluation at the time of admission of a partner, we take into account. So if there will be any gain, it will be credited to revaluation account, as you already know. And if there will be any loss, revaluation account will be debited. So here I prepare the revaluation account. In the question, you must have noticed there were three important informations with respect to revaluation. The first one was with respect to fixed asset. It was written in the question that fixed assets were overvalued by 1 lakh, isn't it? And I told you it means actually it is a loss. That means fixed assets which are written in the books have been written at a value which is higher than the market value. And this time, because it is given fixed assets are overvalued by 1 lakh, so that means we have written fixed asset in the books at a value which is higher than the market value by rupees 1 lakh. So in order to bring it back to the market value, we will have to reduce it. So that is why it will be considered as a loss. So I will write here to fixed asset. So revaluation account debit to fixed asset, that means I am passing the entry. So fixed assets will have to be reduced by rupees 1 lakh, correct? Similarly, next line was in the context of the creditors. You must have noticed that creditors were written in the balance sheet at a value of rupees 1 lakh. But we estimated now that we are supposed to pay to creditors only rupees 50,000. So we are gaining by 50,000. So I am going to put it towards the credit side. On the credit side, I am going to write by creditors. So creditors amount I am going to write here 50,000. So this is a gain to us. Besides that, there was another information with respect to unrecorded bill, if you remember. Correct? It was written in the question that there is an unrecorded bill with respect to prepaid expenses. Because we have already paid the expenses and I haven't yet recorded it, and expenses have been paid in advance. So suddenly I will find, oh, I have already paid the expenses, so it is a gain to me. So that is the reason I am going to write towards the credit side unrecorded. See, I am writing U/R. It means unrecorded. Unrecorded prepaid expenses. Prepaid expenses. Unrecorded prepaid expenses. So unrecorded prepaid expenses in this question is 10,000. It will also appear later on towards the asset side. Any unrecorded item will find place twice, once in revaluation and second in balance sheet. Is it clear to you? So, all the information which was related to revaluation account we have already now incorporated. After having incorporated the information, now we are in a position to tally it. Our debit side total is higher. Because debit side total is higher, that means we are incurring a loss. So on account of revaluation, there is a loss to the extent of 40,000. Obviously, whatever loss or gain which would arise because of revaluation, it will be credited and debited, correct, to old partners only, because in this case, there is no share of old partners. Is it clear to you? So I will write here loss transferred to. So this loss will be transferred to whom? It will be transferred to Parker and Knight. Remember one thing, everything is done in old ratio. Most of the time I've seen students are a bit confused, so where to use new ratio, where to use old ratio, where to use sacrificing ratio. Only in the context of goodwill, when you are going to credit the amount of goodwill, correct, to the old person, then only you will require sacrificing ratio. Otherwise, everywhere, unless and until I will say something else, till up to that particular point, you must understand that everywhere you are going to use old ratio only. So 40,000 will be divided between what we call old partners in the ratio of 3/5. That will be equal to, I think, 24,000 if I am not wrong, and 16,000. Take care of calculation also. You must also do calculation simultaneously, correct? Sometime it happens, we might commit a figurative mistake. So that is the point which you need to take care of, correct? Now, after having prepared the revaluation account, I need not require to tell you time and again that, especially after you people have already reached at this particular level, I know that some of you might feel bad. Little bit, sir, you are starting with too much of a scratches. We are quite well aware of all this thing, but still, actually, I simply want you to orient, correct, according to my way. That's the reason, actually, we are doing all these things. Now, besides that, I will prepare the capital accounts. You know, actually, how to prepare the capital accounts. So I'm going to prepare the capital accounts of the partners. There are 3 partners in this particular case, correct? 2 old partners, 1 incoming partner. So first I stress the line. Okay, just to make the point a little bit more clearer. Parker, then Knight, and then Roger. Parker, Knight, and Roger. Whenever you prepare the partners, whenever you are going to prepare the partner's capital account, first of all, you will look into the balance sheet. You will try to find out what is the amount of the capital. Okay, go through your balance sheet and tell me what is the amount of capital of Parker. As per the balance sheet, I will look into the balance sheet, and this is lying towards my left-hand side. The capital, I find that Parker's capital is 3 lakh and Knight's capital is equal to 2 lakh. I kept the question sheet in front of me also. And obviously, no question of any balance brought down of new partner, correct? Well, after having written down the capital account, your next step should be, if you can adopt this sequential or what we call methodology of solving the question, it will help you a great deal, especially when lots of adjustments will be there, correct? It is always better after what we call bringing down the balances of the capital, it is always better to take care of revaluation. Now, in this case, revaluation loss is there. Obviously, I am going to post the revaluation loss to the debit side of the partner, 24,000 to Parker's and 16,000 to Knight. Correct? obviously dash with respect to R. Now the next step is, once you are done up with these two steps, your next step should be take care of the entries which you have just written down. Your first entry was cash account debit to R's capital account. So because as per the entry R is getting credited on the credit side of the R, I am going to write first of all here by cash. That is 1 lakh rupees. So I am going to write here 1 lakh. Because this account is affecting cash account also, although it is not necessary, but just for the sake of better understanding, I am preparing cash account also, correct? Although it is not needed, but just to make you understand a little bit better, I am preparing cash account also. And there is a fundamental rule in accounts. Whenever you prepare any account, first always check whether you are having any existing balance of cash or not. Now look into your balance sheet and let me know actually whether you are having any cash balances or not. I will look into the balance sheet. On the asset side, I find that cash is written. So my first step should be to write here to balance brought down. Cash is an asset, so balance will be brought down towards the debit side. So I will write first of all 1 lakh because this was existing cash. I'm preparing cash account and already there is a balance in the balance sheet with respect to cash account. So I'm going to write here 1 lakh. Now I will take care of the entry. The entry was cash account debit to R account. We have already written in the capital account in the column of the R by cash. So I will cross it now to the debit side of R's, to the debit side of cash account, and I will write here to R's capital account, that is 1 lakh. Correct? Now my second entry is cash account debit to premium for goodwill account. Cash account debit to premium for goodwill account. This entry is affecting two accounts, cash account and premium for goodwill account. Generally, there is no need to prepare premium for goodwill account. So we are not preparing premium for goodwill account. Is it clear to you? You need not require to prepare just to make you understand better. Suppose if I would have prepared premium for goodwill account, I would have written here by cash. Because entry is cash account debit to premium for goodwill account. You need not require to prepare, just to make you understand. Entry is cash account debit to premium for goodwill account. Premium for goodwill account is getting credited. On the credit side, I will write by cash, and on the debit side of cash account, I will write to premium for goodwill account. Correct? 50,000. The next entry is premium for goodwill account debit to Parker tonight. Premium for goodwill account debit. So premium for goodwill account is getting debited as per the entry. Premium for goodwill account debit to Parker tonight. So on the debit side of premium for goodwill account, I will write to Parker tonight. 30,000, 20,000. And Parker and Knight are getting credited. So on the credit side of Parker and Knight, I am going to write here premium for goodwill account, that is equal to 30,000 and 20,000. So we have posted all the entries which we have written. You can see here premium for goodwill account is automatically getting tallied. So that is the reason why I would not like you to prepare actually premium for goodwill account. So there is no need to prepare premium for goodwill. This is just for understanding. Is it clear to you? Because ultimately this account automatically gets tallied. Now once you have incorporated the balances, number one, once you have incorporated the revaluation account, once you have incorporated all the entries with respect to capital and goodwill, then you are in a position to balance the partner's capital account. So now we are going to balance the partner's capital account, and we shall try to find out what is the balance after the admission of the partner. So after the admission of the partner, what is the balance now? Let us have a look. So first of all, we are going to tally this particular account. The total is 3 lakh plus 33 lakh 30. I am going to subtract 24,000. So balance which I am going to get is 3 lakh 6,000. So I will write here 3 lakh 6,000. Here 2 lakh 20 minus 16. So balance will be equal to 2 lakh 4,000. 2 lakh 4,000. And balance in R's capital account will be equal to 1 lakh. That means after the admission of the new partner, the capital balances of P, K and R is 3 lakh 6,000, 2 lakh 4,000 and 1 lakh. Is it clear to you? Similarly, now we are going to tally cash account. Now we are tallying the cash account. So what will be the balance in the cash account? Obviously, the balance will be equal to 2 lakh 50,000. Balance is 2 lakh 50,000. So we have prepared the balances. Is it clear to you? And obviously now your next step is to prepare the balance sheet. Now we are going to prepare the balance sheet. In order to prepare the balance sheet, it is known as post-admission balance sheet. Post-admission balance sheet, correct? So after the admission, what is the situation or what is the scenario of the position of this particular firm? Let us have a look over it. So as far as balance sheet is concerned, that should not pose you any difficulty, although I have seen students find this step as the biggest hurdle to solve the question, because you haven't paid any attention. First of all, what you do, look into your old balance sheet. Where is the old balance sheet? Is lying towards my left hand side. Look into the balance sheet. Correct? What is the first item? You let me know in the balance sheet towards the asset side. Sir, asset side, the first item is fixed asset. Well, it is the fixed asset. First, immediately write this particular item. I will make you absolutely deaf. Don't worry about that. Fixed asset in the balance sheet is 5 lakh as per your old balance sheet. Now you think of, or you simply look into the ledger accounts which you have prepared. Have you written fixed asset in the ledger account? Yes, sir. We have written fixed asset in the revaluation account. That means the value of the fixed asset is fluctuating. That means it is falling down because you have written fixed asset on the debit side. Is it clear to you? So that is why you are going to subtract 1 lakh from the fixed asset, and now the value of the fixed asset will be equal to 4 lakh. Is it clear to you? That is how you are supposed to prepare the balance sheet. Now you let me know what is the second item in the balance sheet as far as your asset side is concerned. There were only 2 items. Second item is cash. So I will write here cash. Very important point to understand. Because you are preparing the cash account, don't write immediately 1 lakh here. Is it clear to you or not? Because you are preparing the cash account, now you will think of what is the latest balance. The new balance is 2,50,000. So that means cash will appear in the balance sheet at 2,50,000. So you have exhausted all the items of your old balance sheet. Now you look towards the liability side. What is written in the liability side? Sir, capital accounts. Okay, I will write capital accounts. Now capital accounts. Because in the balance sheet it was written capital accounts, so immediately you think of the new capital balances now. The new capital balances of Parker is 3,04,000. 3,04,000. And new capital balance of Knight. New capital balance of Knight. What is the new balance of Knight? New balance of Knight is 2,04,000. So we shall write here. In fact, the balance of Parker is 3,06,000 and 2,04,000 is the balance of. This is 3,06,000 and 2,04,000 is the balance of Knight. And besides that, because a new partner has been admitted, and his capital balance is 1 lakh. So because in the new firm, there are 3 partners and their respective balances we have written. Now, what is the next item which is given in the balance sheet? You let me know of that also. Sir, in the balance sheet, the next item is creditors, right? Creditors were rupees 1 lakh. Creditors were rupees 1 lakh without an iota of doubt. But in the revaluation account, you have credited creditors by 50,000. Because you found that you are supposed to pay to the creditors only 50,000 and not 1 lakh. So you will have to reduce the creditors by 50,000. Correct? And that reduction is a gain to you. So 1,50,000. Sorry, only 50,000. You are going to write in the balance sheet. Is it clear to you or not? So very simple to prepare the balance sheet. It is not a very tough nut to crack. However, let me caution you. Don't make harakiri. Harakiri means unnecessarily jumping over the things. So point here is that which you need to understand. Once you have gone through all this step, it is very, very important for you to check your revaluation account. Why? You must take care of this particular fact, whether you have adjusted each and every item or not. Because otherwise, your balance sheet may not match. For example, if I am going to tally my balance sheet at this particular moment, it will not match. Why? I will tell you. See here, in the revaluation account, we have fixed asset. We have adjusted this 1 lakh. We have subtracted fixed asset from 1 lakh worth of fixed asset from 5 lakh. And then creditors we have subtracted. Now, even loss has been written in the capital account. You can see everything has been adjusted except unrecorded prepaid expenses. Unrecorded prepaid expenses is considered as a gain to you because you have already paid some expenses and you are unaware of this. But suddenly you find that we have paid some prepaid expenses, so it is a sort of asset because prepaid expenses are considered as an asset. So you must not forget to write prepaid expenses, unrecorded. Now don't write here unrecorded because now you have recorded. So prepaid expenses worth rupees 10,000. So now you are going to match your balance sheet and you will find that your balance sheet is matching down. Is it clear to you or not? Is it clear? Absolutely clear? Okay, sir. So this is how we have to move as far as these things are concerned. Now, we will come back to the situation. Okay, this was case A. Correct. Now we are taking up case B because same question. Question is same. Only thing is that case is changing. Now under case B, what is written? Show various relevant ledger account if partner decide to adjust their capital according to new partner's capital or as per new profit sharing ratio. Question is same, but only thing is that when everything is same, the balance sheet is same. Old partners Parker and Knight, their profit sharing ratio is 3:2. A new partner Roger is coming into the firm for 1/5 share. He is bringing 1 lakh as capital and 50,000 as a share of goodwill. And now the question says that show necessary relevant ledger accounts if partner decide to adjust their capital according to new partner's profit sharing ratio. This is the point which you need to understand. Is it clear to you or not? So we will solve this question again. So let me create the space. So in order to solve this question, this is case B. Question number 2, but this is now case B. Because data is same, everything is same, still actually I would love you to pay attention even though everything is same. Correct. First of all, you need to pass the entries. If you are going to pass the entries, the same entry I am going to repeat, the cash account debit. Correct. Cash account debit. 2. New partner account. The new partner is actually Roger. He is coming up with 1 lakh worth of capital. So I will write here 1 lakh. Correct. The more you practice, the more perfect you will become. Then he is bringing in 50,000 for his share of goodwill. Your next entry will be cash account debit. 50,000. 2 premium for goodwill account. So you will write 2 premium for goodwill account. PFGW 50,000. Now credit this share of goodwill to the old partners in their sacrificing ratio. So premium for goodwill account debit to Parker's capital account, to Knight's capital account. In sacrificing ratio will remain equal to old ratio because whenever in the question only old partners profit sharing ratio and new partners profit sharing ratios are given, sacrificing ratio will be old ratio. So 50,000, 30,000 will be credited to Parker. Knight will be credited with rupees 20,000. Same thing, same picture before you. Correct. After this, now we are in a position to prepare the revaluation account also. Now we shall prepare the revaluation account. Step number 2, revaluation account. Again, we will get the same thing which we just noted down earlier. Correct. Revaluation account. Because same question is there. Although I can simply say that loss is 40,000, but just actually I want you to have bit of practice. In the question, first of all, it was given that fixed asset was overvalued. So we considered it as a loss because we have to bring down the value of the fixed asset by 1 lakh rupees. So I'm going to write here 1 lakh. Then in the question, it was given that creditors which were recorded in the balance sheet at 1 lakh were found at 50,000. So creditors will have to be reduced by 50,000. So 50,000 is a gain. Then there is another gain in the form of unrecorded prepaid expenses. unrecorded prepaid expenses 10,000. So that is why there is a loss to the extent of 40,000. So loss of 40,000, which we have already computed. But just to make you understand better, Parker and Knight, the loss will be divided between or among the partners in old profit sharing ratio, which is 3:2, 24,000, 16,000. Well then, after having done till up to this particular moment, now we are in a position to prepare their capital accounts also. Correct? This is step number C, capital accounts. Now we shall prepare the capital account. Capital accounts. In order to prepare the capital accounts, you can see this time I am preparing little bit longer capital accounts. One is Parker, another one is Knight, then Roger. Parker, Knight, and Roger. Let me create a bit of space for me. Okay. First of all, we will bring down the balances. Your first step, balance brought down. As per the balance sheet, capital balances of Parker and Knight 3 lakh and 2 lakh respectively. Correct? I hope till up to this particular point there should not be any problem. What I told you in the first case, after having brought down the balances, the next point for you is to take care of the revaluation. So revaluation account 24,000 and 16,000. What is the next step? Take care of the entries. Your first entry is cash account debit to R's capital account. So you are going to write by cash 1 lakh rupees. And if you are interested in preparing the cash account, you can prepare that also. So cash account I will prepare. Cash account. In the cash account, first of all, you must not forget to write the balance brought down. The balance brought down is equal to 1 lakh. Correct? Balance brought down is equal to 1 lakh. You have written here on the credit side of R, you have written by cash. Obviously, you are going to write now towards the debit side of cash account to R, that is 1 lakh, is coming up with rupees 1 lakh worth of capital. Besides that, your next entry is cash account debit to premium for goodwill account. We are not preparing premium for goodwill account, but cash account is getting affected, cash account is getting debited. So we shall write here to premium for goodwill account, 50,000. And because I am not preparing premium for goodwill account, no second posting. If I would have had prepared premium for goodwill account, I would have had written towards the credit side by cash. Is it clear to you? Now, next entry is premium for goodwill account debit to P2K. So, because of premium which has been brought in by the incoming partner, the old partners will getting some credit. So, next entry is premium for goodwill account debit to Parker, and Parker will get a credit of 30,000 and Knight will get a credit of 20,000. Is it clear to you or not? After this, suppose if I am going to balance this, and I am going to ask you, what are the balances? Quite obviously, within a flick of second, you will tell me, sir, balance in P's capital account is 3,06,000. And balance in Knight is 2,04,000. And balance in R's capital account is 1 lakh. Correct? After writing these balances, now in the lower part you write balance brought down. In the lower part you write by balance brought down. These balances, correct, which you have written. 3,06,000. Then 2,04,000. And 1 lakh. What was written in the question, now you let me know. As far as your second case is concerned, look into the second case. It is clearly given in the second case that we are supposed to prepare the ledger account if partner decide to adjust their capital according to new partner or as per new profit sharing ratio. Correct? Now, in this question, we will have to do some capital adjustment, and you have done it so often in the past, as you know. Isn't it or not? You have done it so often in the past, capital adjustment. Now, but still, I have already told you, we are trying to recap the things, correct? The basic purpose of solving this particular question is to do the recapping. Now, I will tell you how to do the capital adjustment, correct? Capital adjustment. In order to do the capital adjustment, so sometime partners decide that they are going to keep their capitals, correct, in the new ratio or in proportion to new partners' profit sharing ratio. So capital adjustment. Capital adjustment. When we do the capital adjustment, under it, first of all, what we are supposed to do, we are supposed to first of all write new firm's capital. New firm's capital. What will be new firm's capital? New firm's capital. First of all, we shall have to write new firm's capital. Correct? And new firm's capital is very easy to find out. In order to find out the new firm's capital, all you have to do is, first of all, think of the capital balances. Think of the capital balances after all the adjustments. For example, new partner's capital is 1 lakh. And after all the adjustment, the balance in new partner's capital account is still 1 lakh. Is it clear to you or not? Please pay attention, because most of you, because of your past way of computing doing the capital adjustment, you are under an impression that in order to compute the new firm's capital, we take into account new partner's capital. Again, it is no problem, but you must understand what we mean by new partner's capital. New partner's capital doesn't always means whatever capital he's bringing in. It means the balance in the new partner's capital account after all the adjustment prior to the capital adjustments. Because under rare circumstances, it could be a possibility that whatever he is bringing in may not match with the balance. Are you getting my point or not? So we have to take this balance. That means after all the adjustment, but before the capital adjustment, whatever balance will be existing in the new partner's capital account, we will consider this. Is it clear to you? So for 1/5 share, capital balance of R is 1 lakh. Is it clear to you? So on the basis of this, we have to find out the new firm's capital. So in order to find out the new firm's capital, all you have to do is just take into account the capital balance of the new partner after all the adjustments, but prior to the capital adjustment. And now you will have to divide it by his profit sharing ratio. His profit sharing ratio is 1/5. So that will easily tell you, if we will take the new partner's capital as the base, that means for 1/5 share, he is bringing in 1 lakh. So if he would have been given entire share of the firm, he would have brought in 5 lakhs. So new firm's capital will be equal to 5 lakh. That is 1 lakh into 5/1. That is equal to 5 lakhs. So new firm's capital is 5 lakh. Is it clear to you? After having done this, what we are supposed to do then? Then I will write here proportionate share of capital. Proportionate share of capital. Proportionate share of capital. What we mean by proportionate share of capital? That means this is new firm's capital. And whatever will be my profit sharing ratio in the new firm, I will multiply it with 5 lakhs to get my proportion of capital. Are you getting my point or not? So proportionate share of capital means new ratio of each partner multiplied with this capital. For example, if suppose I want to know what will be the capital of Parker, not A. Just wait for a while. We have a habit of writing ABC, so that is the reason. Parker. Now new firm's capital is 5 lakh. Now I will have to multiply it with the new ratio of the Parker. So that means in order to find out proportionate share of capital, we need to have the new profit sharing ratio also. Are you getting my point or not? And it is not very difficult task to find out the new profit sharing ratio. You can within a flick of second, find out the new profit sharing ratio. What will be the new profit sharing ratio? Suppose if I am going to ask, new profit sharing ratio will be, say here, I have told you already, when only old partners profit sharing ratio is given and only new partners profit sharing ratio is given. Correct? So, new profit sharing ratio will be equal to remaining profit, RP, remaining profit into old profit sharing ratio. And what we mean by remaining profit? Suppose if new firm's profit is 1 and new partner share is 1/5, so remaining profit will be equal to 4/5. So remaining profit is 4/5 and old profit sharing ratio is 3/5. So that will give me 12/25. 12/25. So new profit sharing ratio of Parker in the new firm will be considered as 12:25. Now if I will look over Knight, as far as Knight is concerned, remaining profit will be 4/5 and we are going to multiply it with his old profit sharing ratio, which is 2/5, and we are going to get 8/25. We are going to get 8/25. Is it clear to you? Fine, sir. And what is Roger's share? Sir, Roger's share is actually 1/5. If I will convert it into denominator of 25, how I am going to convert it? So I will have to multiply it with 5/5. In order to convert it into denominator of 25, I will have to multiply this 1/5 with 5/5. So that will be equal to 5/25. So we may say that in the new firm, their profit sharing ratio is 12:8:5 or 12/25, 8/25. Isn't it or not? Here, one thing, if you will note very carefully, see here, 12:8:5. No doubt, this is the new ratio. See, we are taking and consuming a bit of time, even I know. But point is that I would like you to pay attention. That will help you a lot later on when you are going to solve lengthier questions. Correct? Here you might feel that your time is little bit being stressed, but over there you'll find that lots of time is being saved. For example, if you are going to pay lots of attention here, you will find that ratio between A and B is still 3:2. Even in the new firm, ratio between A and B, or Parker and Knight, sorry. So Parker and Knight, old partners, 12:8, ultimately it is 3:2. It hasn't changed still, if you will look very carefully. But anyway, so new ratio we have computed. Now we are in a position to find out their capitals very easily, and we can do so now. So 5 lakh into 12/25 into 12/25. That is equal to 2,40,000. This is how you used to compute new partners' capital whenever capital adjustment question used to come in the examination. Isn't it or not? Here it is clearly written in case B that partner decide to adjust their capital according to new partners' capital, or they want to have their capital as per new profit sharing ratio. Correct? So first of all, we found out the new firm's capital, and then we found out the new profit sharing ratio, and now we are simply multiplying this capital with their respective ratio. So proportionate capital of P in the new firm will be equal to 2,40,000. Similarly, if I am going to write here Knight's capital, the Knight's capital will be equal to 5 lakh into 8/25. 8/25. And that will be equal to 1,60,000. This is how you used to compute. And as far as Roger is concerned, you need not require to do any calculation. Roger's capital will be 1 lakh. Why? Because on the basis of his capital, new firm's capital is found out. Even if you are going to multiply it 5 lakh with what we call Roger's ratio, 5/25, you will still get what we call 1 lakh. So in the new firm, capitals of the partners will be 2,40,000, 1,60,000 and 1 lakh, or we may say that partners have decided that they are going to keep this much of capital in the new firm. So what my point is, see here, actually their existing capital at this moment is 3,06,000, 2,04,000 and 1 lakh. Is it clear to you? But now we have done the capital adjustment, and we have seen that as per the capital adjustment, the capitals of the partners, so this will become the balance carried down. This balance carried down has come from working notes. Correct? WN means working notes. In the working note, we found out that capital of P in the new firm should be equal to 2,40,000. So I'm going to write here 2,40,000. Is it clear to you? Then capital of K in the new firm as per the working note is equal to 1,60,000 because they want to keep their capitals in profit sharing ratio, and capital of R in the new firm will be equal to 1 lakh. So whenever there will be capital adjustment and whenever it will be written in the question that partners decide to keep their capital correct in proportion to new profit sharing ratio or on the basis of new partners profit sharing ratio, in that particular case, it is always better to prepare the capital account in this manner. Correct? Is it clear to you or not? First, you do all the adjustment without taking into account the capital adjustment. Then take the balances, bring them down, and then write here what we call your capital, which you have found out through your working notes. And then ultimately what you have to do. What you have to do now, obviously you will take the differences. Actually, capital of P in the new firm is 3,06,000 actually. But now, as per the agreement, his capital should be only 2,40,000. That means he is having surplus capital. We call it surplus capital. So we will take the difference of these two. The difference of these two is equal to 66,000. Correct? 66,000. This difference, because he is having extra capital, this difference will be paid to him. Is it clear to you or not? So we will pay 66,000 to Mr. P, and we will write here 2 cash. We will write here 2 cash, and actually this is the balancing figure. That means whenever partners are going to adjust their capital on the basis of new profit sharing ratio or on the basis of new partners capital, you will have to prepare the capital accounts in this format, number one. Number two, there will obviously be some surplus or some deficient balance. If there will be surplus, that partner will be paid off. We will write here 2 cash. And the moment I am going to write here cash, I should not forget to write on the credit side of the cash account also. So I'm going to write on the credit side of the cash account by P. This is surplus capital 66,000. Is it clear to you or not? Clear? Similarly, the capital of K now. Now we have seen that capital of K is 2,04,000. Actually, the required capital is only 1,60,000. So again, Mr. K also is having surplus capital. So surplus will be paid off. So 44,000 we shall pay off. 44,000. So again, I am going to cross it to the credit side of cash account by K, surplus cash. It means surplus cash is paid them. Sorry, surplus capital is paid off them for 44,000. Now, obviously, as far as R is concerned, there will be no balance because on the basis of R's capital, new firm's capital has been found out. Number one. Number two. Now I am going to tally this account. Correct? If I am going to tally this account, the balance carried down will be equal to how much? The balance carried down will be equal to 1,40,000. Balance carried down is equal to 1,40,000. So in the balance sheet, what change will take place? The balance sheet which we prepared earlier, almost same balance sheet will be there. Only difference is that now the figure of cash will be 1,40,000, correct? And capital balances will be this much. Is it clear to you? For the sake of better understanding, I will prepare the balance sheet also, correct? For the sake of better understanding, I will prepare the balance sheet for you also. I will prepare it here itself just to save the things. So balance sheet we shall prepare, post-admission balance sheet. Now, in order to prepare the post-admission balance sheet, fixed asset, earlier they were 5 lakh. But now the fixed asset will appear at 4 lakh, 5 lakh minus 1 lakh. You can straight away write 4 lakh. Similarly, cash balance. Earlier in the balance sheet, cash balance was 1 lakh. But now, after all the adjustment, balance in cash is 1,40,000. So I'm going to write here 1,40,000. And because there was prepaid bill, there was bill for prepaid expenses. I will write here prepaid expenses also to the extent of 10,000. I have already told you, nothing much will change as far as asset side is concerned except the cash balance. Now coming over to the liability side. On the liability side, now we shall write the capital accounts. Now capital account of Parker, we have just computed 2,40,000. The new capitals, correct? The new capitals which you have computed, because this is your capital balance, 240, 160 and 1 lakh. So Parker 240, Knight 160 and Roger, you are going to write here 1 lakh. Besides that, you should not forget to write creditors. Now amount of creditors will be equal to 50,000. So this is how you are going to prepare the balance sheet in this particular case. Is it clear to you or not? I hope now things are getting recapped to you. So after having done this one, now we move over to the next point, correct? In the next point, what we are going to discuss, let's have a look also. Now, case C we will pick up, correct? Case C, just wait for a while. Case C we are picking up. And in order to pick up case C, what I am going to tell you, see here, first have a look over the questions. Let me put the sheets over here and bring down the question before you. Here it is. Now in case C, same question is there, but in case C, what does the question states? In case C, the question says again that we are supposed to prepare all the relevant ledger accounts. Presuming new partner brings only 50,000 for goodwill. Now, in this case, you have to presume that new partner is bringing only his share of goodwill and shall bring proportionate share of capital. Proportionate share of capital. That means, again, actually many among you are under a confusion that this is a case of capital adjustment. It is not a case of capital adjustment. Capital adjustment case is case B. This is not a capital adjustment case. Only thing is that you have to find out the new partner's capital. Are you getting my point on it? That is the reason why I am recapping the things, because I know that some of the students are not quite well acquainted with the actualities and the actual facts. The point is this. So here in this case, only thing is that how much new partner is bringing for goodwill, it is given. And how much he is bringing in for his share of capital, it is not given in a straight manner, in an absolute manner. Rather, it is given to you in a disguised manner that he shall bring his proportionate share of capital. What we mean by proportionate share of capital? It means he will bring capital in proportion to his profit sharing ratio. And what does it mean? It means he will bring one-fifth of the capital of the new firm. So even in this question, we will have to find out the new firm's capital and we will multiply it with 1/5 because the share of the new partner is 1/5. We will be able to get his share of capital. Number one. But we need not require to adjust the capital of the old partner. So that is why this is not a case of capital adjustment. Capital adjustment case will be only when it will be written in the question that new partners have decided to adjust their capital on the basis of new partners' profit sharing ratio, or they want to keep their capital in new profit sharing ratio. Only this case is considered as a capital adjustment case. This case is a case wherein we have to simply find out the new partner's capital, how much he is going to bring in. Is it clear to you or not? Everything is same. So we will do this particular question also, because we have to recap the things. Point which you need to understand is, so in order to do this particular question, again, I will have to create the space, correct? So I will create the space. Well then. So in order to do this particular question, case C now I am doing. Try to understand. Case C I am doing. Case C. Under case C, just to make you understand better, as a habit, you can say, we have now decided to write the entry first of all for the capital, because we have become habitual to it now, isn't it or not? Cash account debit to Roger's capital account. But problem is that how much Roger is bringing in right now, we are unaware of it. We do not know how much amount he is bringing in for his share of capital. Okay, don't worry, leave it as it is. Now, at least how much he is bringing in for goodwill, we are aware of it. So we are going to simply write cash account debit. Cash account debit. He is coming up with 50,000 share of goodwill. At least we can write this entry. Cash account debit to premium for goodwill account. Isn't it? To premium for goodwill account. So I will write here to premium for goodwill 50,000. Clear? And then whatever goodwill he brings in, we have to credit it to the old partners, quite obviously. So premium for goodwill account debit. Premium for goodwill account debit. Now we will credit the same to Parker and tonight. To Parker tonight. So often I have told you that this amount will be credited to old partners in their sacrificing ratio. 30,000 and 20,000. Clear? Okay, sir. It is also clear. If it is clear, now what is your next step? Under step number B, we are supposed to prepare the revaluation account. Now, I'm not preparing revaluation account. I'm simply telling you because we are going to get the same thing, revaluation loss, because we have already prepared. You can see here. So, revaluation loss is 40,000. I'm simply writing 40,000. Revaluation loss is 40,000. Correct? Because same question is that. Now we are, after having prepared the revaluation account, now we are supposed to prepare the partner's capital account. Now we shall prepare the partner's capital account. Capital accounts. In order to prepare the capital accounts, now we are going to prepare the partner's capital account, as you know, but in order to prepare the partner's capital account, see here what I am doing. This much of space is not sufficient. Just wait. Okay. So, I will write here Parker. I will write here Knight. I will write here Roger. Parker, Knight, and Roger. Correct? First of all, we bring down the balances. I bring down 3 lakh, 2 lakh. 3 lakh, 2 lakh. Correct? So balances have been brought down. What is the next step? So next step is revaluation, right? Revaluation loss is there. So 24,000 and 16,000 revaluation loss we have written. Correct? After that, entry for bringing in capital. Okay, I will write here by cash. Correct? But unfortunately, right now, I'm unaware of the amount, how much he is bringing in for his share of capital. Correct? Then this is our cash account. This is our cash account. This is our cash account. In the cash account, I will write balance brought down as usual because in the balance sheet, balance is there, 1 lakh. And then I will write here 2R, but again, I'm unaware of the amount which has been brought in as capital by R. Next entry, cash account debit to premium for goodwill account. So our cash will increase. So I will write here premium for goodwill account, 50,000. However, we do not prepare premium for goodwill account. So that is why I will not write anything in premium for goodwill account. Then our entry will be premium for goodwill account debit to P to K, isn't it or not? So I'm going to write here premium for goodwill account and 30,000 will be credited to P and K will be credited with rupees 20,000. Is it clear to you? Okay. Everything is done. Correct? Only thing is that we are unaware of the amount brought in by R. Otherwise, rest of the things have already been incorporated. So after this, what you are going to do, you simply balance at least old partner's capital account. You can balance the old partner's capital account. If I am going to balance the old partner's capital account, the balance will be 3 lakh 30 minus 24, 3 lakh 6,000. Correct? And 2 lakh 4,000. These are the balances. Is it clear to you or not? New partners capital balances we need not require to adjust. Only thing is that we have to find the new partners capital. So this question is not a capital adjustment question. Is it clear to you? Don't be under this particular phobia that this is a capital adjustment question. Now how to find the new partners capital? Determination of new partners capital. Determination of new partners capital. So determination of new partners capital. So new partners capital we have to now find out. New partners capital. Determination of new partners capital. So how much new partners shall bring as a share of capital we have to find out. Correct? Whenever you are supposed to find out new partners capital, all you have to do is, first of all, you write here balances after all the adjustment. Balances after all the adjustments. All the adjustments. Balances after all the adjustments. So balances after all the adjustments. If I am going to ask you what is the balance of P, you have just done the adjustment. Sorry, you have just done the what we call totaling. 3,06,000 is the balance and 2,04,000 is the balance. Isn't it or not? So you will write here 3,06,000. 3,06,000. Then you write the balance of K. Balance of K is equal to 2,04,000. 2,04,000. Is it clear to you or not? Then you tally it. By tallying it, you will get 5,10,000. This is known as combined balance. It is known as combined balance. It is known as combined balance. Correct? That means in the new form, the capital of P and K is equal to 5,10,000. Is it clear to you or not? This is the first thing which you are supposed to do. You have to find out combined balance of the old partners in the new form. After having found out, you divide it by remaining profit. You divide it by remaining profit. You divide it by remaining profit. In what we mean by remaining profit? Remaining profit means new form's profit as 1 and new partners profit sharing ratio is 1/5. So remaining profit is 4/5. Actually, logic is this. What does this remaining profit signifies? Remaining profit signifies the combined profit sharing ratio of old partner in the new firm. See, in the new firm, out of 1, new partner share is 1/5. So whatever is remaining, combinedly it is the what we call profit, it is the what we call share of the old partners. So combined profit sharing ratio signifies the combined profit sharing ratio of the old partner in the new firm. So now we have developed an equation that for 4/5, because the combined profit sharing ratio is 4/5, for combined profit sharing ratio of 4/5, capital of what we call partners is 5,10,000 combined capital. In the new firm, their capital is 5,10,000 combined capital and their combined profit sharing ratio is 4/5. So what will be the capital of the new firm? So that you can find by dividing 5,10,000 by 4/5, that is 5,10,000 into 5/4. Now you can easily get what we call new firm's capital. So what will be the new firm's capital? If my calculation is correct, 6,37,500. 6,37,500 will be new firm's capital. So if new firm's capital is 6,37,500, now I can easily find out the capital of the new partner. Therefore, Roger's share of capital, how much capital he will bring? Roger's share of capital will be equal to 6,37,500 into 1/5. Quite obviously, he will have to bring proportionate share of capital. That is equal to 1,27,500 So now we have found out that Roger actually is bringing in 1,27,500. But don't be under an impression that this is a capital adjustment question. Only thing is that you are simply determining the new partner's capital. Is it clear to you or not? So now we can say that new partner is bringing 1,27,500 as capital. Cash account debit to R's capital account, 1,27,500. Is it clear to you? And here, now we can write, 1,27,500 because he is coming up with 1,27,500 as capital. And here I will write 1,27,500. Is it clear to you or not? Yes, sir, absolutely clear. If it is clear, now what will be the balance of the new partner? Quite obviously, the balance will be 1,27,500. So in the new firm, the capitals of these three partners will be 3,06,000, 2,04,000 and 1,27,500. And similarly, if I am going to ask you the balance carried down in the cash account, balance carried down, what will be the balance carried down? The balance carried down will be equal to how much? 2,77,500. 2,77,500. And suppose if I am going to ask you how you are going to prepare the balance sheet in this particular case. In this particular case, how you are going to prepare the balance sheet. Your balance sheet will be almost same. The balance sheet which we prepared earlier, fixed asset will come at 4 lakh only. Now cash balance will be 2,77,500. This item will remain same. Now capitals, you will write the new capitals, that is 3,06,000, I think. And then you will write 2,04,000 case capital. In this case, case number C, I am talking about R's capital 1,27,500. 1,27,500 and creditors will appear at 50,000. Is it clear to you or not? So I think we have already recapped whatever we are supposed to do or whatever we did in our earlier phases of education. Do you remember? These are the things which you did in your earlier phases of education with respect to comprehensive questions, correct? Just we take a break of 5 minutes and then we will continue. 5 minutes break we are picking up, correct? So welcome again to this session after the break, and now again we'll move back to the question sheet. Correct? Just wait. Sometimes this mouse plays tricky games. Oh, okay. We come back to the main question now. Here it is. Case D is also there so that we can wrap this one also. Comprehensive revision of the concepts which we are already familiar with. We are picking up now with the help of case D, and here it is written, show all relevant ledger accounts. Presuming new partner brings only 50,000 for goodwill. Same line. And 1/5 of the total capital of the partners. Now, what is the difference between the earlier line and this line? In this question also, it is also first of all not a capital adjustment question. Again, you will have to find out new partners' capital. New partners' capital is not given. However, in point number C, it was given that new partner will bring 1/5 of the proportionate capital. Is it clear to you? It was clearly given he will bring he shall bring 1/5 of the, he will bring proportionate share of capital. So in this question, in question number C or part C actually, we had to compute first of all new firm's capital, and then we multiplied it with the new partner's profit sharing ratio to got the what we call amount of share of capital which was brought in by the new partner. However, in this particular case, what it is written, and 1/5 of the total capital of the partners in the new firm. It means this time he will bring 1/5 of the total capital of the partners, means total combined capital of old partners. Total combined capitals of old partners. So this is the difference actually I just wanted to bring to the light. Is it clear to you or not? So I hope you got the difference. In the earlier one, you were forced to find out the new firm's capital. But in this question, we will have the same methodology. But only thing is that we need not require to find out the new firm's capital. Whatever will be the total capital of the partners, we will simply multiply it with 1/5. I need not require to solve this, but just to make the point clear, I will come back to the solution, which we just did. Correct? And here is the solution. In case C, actually, see here, the total capital of the total combined capital of P and K is 3,06,000 and 2,04,000. I hope you got this particular point, 3,06,000 and 2,04,000. So what I will do in order to find out the capital of the new partner, as I told you, in this particular case, we have to simply take the combined capital of old partner, and we will simply multiply it with 1/5. Now, new partner share is 1/5. I will simply multiply it with by 1/5 to get the new partner's capital, that is 1,02,000. This is the only difference. Is it clear to you or not? Yes, sir, absolutely clear. Now, if it is clear to you, let's try to actually solve one question before we wrap up the things up for the day. And I have started receiving the messages. The movement. Sir, we are tired. So first message on the SAS is there that, sir, we are feeling a bit tired now. So it's okay. So if you are feeling tired, that's enough for the day. So we will continue in the next session. In the next session, we'll try to finish up this section number 2, and we will take some tougher questions, correct? So that you get pretty well acquainted with all the concept in a very, very comprehensive manner. So shall meet you in the next session. So till that particular time, it's time to say goodbye.